Welcome to a special edition of Market Pulse from Equifax, where we break down what's shaping the mortgage industry today and what happens next.
Welcome to the special edition of the Equifax Market Pulse podcast, recorded here at the Equifax booth at MBA Annual 25 in Las Vegas, where industry leaders from across the mortgage ecosystem have gathered and we are exploring one big question: what happens next? I'm Emmaline Aliff, leader of the Equifax Advisors, and today we're discussing one of the most talked about topics in mortgage policy: the true cost, competition, and future of credit reporting in mortgage lending. With the industry discussing potential changes to the tri-merge requirement and entry of VantageScore, there's been a lot of speculation about pricing, competition, and fairness. But what does the actual data show? To help unpack, I'm joined by Dr. Amy Kreuskutz, Chief Economist of AC Cutts & Associates, who recently released a new study around loan closing data that will paint a clear picture of the cost, competitive dynamics of mortgage credit reports. Welcome, Amy.
Thank you.
So the first thing we'd like to discuss and understand specifically is around the real costs of pulling credit and mortgage. So as we think about that, let's start with the headline everyone's curious about, which is the real cost of pulling credit and mortgage. So what's the true picture of credit report costs in a typical home purchase? And how does the data from the last 18 months challenge some of the common perceptions we've seen floating around the industry?
That's a great question. I just came back from a great session at the MBA that talked about this, and one of the panelists said that the average industry cost, or the cost at his firm, is about $155. In my research, I found that it's more that it's a wide range from 40 to about 240. And what goes into that is how many borrowers. If there's a single borrower on there, then the cost would be at the lower end. If there's multiple borrowers, then the cost would be a little bit higher. But there's a lot of dynamics. Credit reports are one of the only charges that can be explicitly charged and passed. It must be passed on directly to the mortgage borrower. The other one is appraisals. And every time I've applied for appraisal, they've asked me for a check up front to pay for the appraisal. A lot of mortgage brokers or mortgage lenders don't ask for that up front for the credit report. They simply pull your credit. And so this is one of the unrecouped costs. If a loan doesn't close, they don't get that money back. The appraiser got paid, they pass that on, but they don't charge for credit reports up front. I don't really know why, but I hear time and again that mortgage reports are too expensive, and it really comes down to this part where people don't close the loan eventually. But let's talk about some other things. They pull a credit report, it's good for 120 days. That is usually enough time to close a loan. But in the meantime, and I've done this myself, I'm guilty of it, sometimes borrowers aren't thinking about the fact they're in the middle of the mortgage process, and they go out and they buy a new car, sign up for that great new credit offer, and now suddenly it shows up on their credit report, and they may not close if it affects the debt-to-income ratio or otherwise impacts that credit. So lenders will often pull a second report closer to closing. Again, adds costs into that process. But the industry has been evolving as the cost of providing a credit report has gone up. The GSEs, which is Freddie Mac and Fannie Mae, require trended data. And trended data is a great innovation. It's been around a long time, but it's only recently shown up now as part of our mortgage process. It's very expensive. You're looking at 6 months or more of data now all compiled. So that's raised the cost of credit reports. In any event, so they pull that closer to closing. You can also buy something called undisclosed debt monitoring, where you pull your initial credit reports and then you say, hey, credit bureaus, if there's any change in this person's credit file, so they applied for an auto loan, they got an auto loan, any of those sorts of things, or put $20,000 on their credit card, ordering those new drapes, that you'll tell me before I get to the closing table, maybe in time to fix it and solve that problem. The cost of a UDM report is, I don't know, $20 to $40, $30, somewhere in that range. A lot less expensive than the cost of a credit report. And it covers that time, not only to the delivery of the loan to the closing table. But Freddie Mac and Fannie Mae rules say, hey, if it's not on our desk, in our possession, you could still be liable for an undisclosed debt, even after closing. So UDM is a great product because it covers all that period. And so there's just, a lot of ways in which costs could be cut. And we're arguing about $155, the guy said today in the panel. We're really arguing about that amount of money. It's crazy to me that that's what we're talking about.
Yeah, especially with the overall costs associated with purchasing a home. It really is a small fraction. Yeah. So let's pivot and talk about competition and tri-merge. So another area you explored, is the competition among tri-merge credit report providers, and with numerous approved sellers of tri-merge reports listed on the Fannie Mae site. How robust is the competition in this market, and do you see significant differences between Fannie and Freddie approved sellers?
So I confess I wasn't able to find the Freddie Mac sellers on their website. Some websites are better than others, and I didn't feel like going through the guide, which is thousands of pages to find it. Fannie Mae made it easy with a Google search. So I looked at 47 approved resellers under Fannie Mae. I can't imagine that Freddie Mac's much different. So we're talking 46 to 48-ish, okay? Every reseller,
50,
every reseller has their own advantages and disadvantages in the products that they offer as ancillary services that go with that. You can negotiate a bulk discount if you do big enough business. Obviously, if you're a smaller lender, you're not going to have as many cost advantages. But nonetheless, I think, a couple things I'd recommend is see what price you're paying and call up a couple and see what they might offer. If you're here at MBA, there's several of them around. So it's possible to find that. With 47, if anybody gets way out of whack, people talk, right? They go to their local conferences and whatnot. They're going to talk. And so you're going to find out that somebody's creating a problem for you. And so, I think that there's a pretty low cost differential, broadly speaking. Even so, it pays to ask that question periodically. Same would be true of your originating software provider and all the other services that you might have. To put in perspective, let's say that a single borrower credit report is $60. And I'm talking about today, not what might happen in the future. There are potentially 5 entities that get compensated out of that $60. You've got your score provider, VantageScore or FICO. You've got your 3 nationwide credit reporting agencies, and you've got your reseller. So out of that, roughly, FICO gets, roundabout, the credit score reseller gets about $15. And then, so that leaves out of that 60, we're talking about $45 to divvy up between up to 4 providers. And so whatever markup might be happening on any part of that or margin, for each of the 3 credit reporting agencies, you've got to cover your compliance costs, your tri-merge delivery costs, your technology costs, right? There's a lot that goes into that. Every time you import a new reporter, there's new compliance costs. It's not cheap to grow your business in terms of the quality of the data. But what are we doing? We're combing every possible, new buy now, pay later as a potential contributor. A lot of discussion about how we would do that. They're not on a typical schedule. How are we going to do that? How are we going to make sure it's reported in a way that the GSEs and everybody else can absorb it? These aren't trivial questions, although everybody's like, wave your wand and it happens instantly. All these new fintechs out there and how they might respond into that. You've got a lot of other things that are provided, verification services of identity. So there's a lot that goes into that has to be accurate. It has to be timely, all those sorts of things. And so they act like it's just trivial, but it's really, those costs have gone up along with everything else. Labor costs, technology costs. You think those data centers are free?
Overall inflation.
Yeah, I mean, there's a lot that goes into that.
Yeah. Maybe you can elaborate a little bit more then, specifically, if we think about a mortgage broker or lender, successfully secure credit service at a significant discount. What does this imply about the current bargaining power and negotiation leverage in the market?
So there's different kinds of credit bureaus. We tend to think of them as all the same. But in technical regulatory language, there's the three nationwide credit reporting agencies, so Equifax, Experian, and TransUnion. And then every reseller is also what's called a consumer reporting agency. We think of them as credit bureaus, but that's what their technical name. And there's more than just the ones we listed because, as an example, if you are a reseller of cash flow data, you're now a CRA. That means a bank could be a CRA, right? So there's a broad terminology on that. In terms of lowering those costs, if I'm a lender and I cut a deal with a CRA, a tri-merge reseller to cut my costs, I can't mark that up. I have to pass that on to the consumer directly. So in every closing document, according to the Real Estate Settlements Procedures Act, you have a disclosure form that comes up before you close, and on that is enumerated how much your credit report costs. So if you, Equifax, save me money on my credit report costs, that goes directly to the borrower, not to my bottom line.
Okay, I want to unpack this a little bit more.
Okay.
What are the implications of off-the-rack pricing being significantly lower than what some regional banks are paying? What does that tell us about the claims that reports are too expensive?
Yeah, so again, this kind of comes back to who's responsible, right? And I'll admit it, how many of us out there have subscriptions to services we've forgotten about? Like, I probably have insurance on my phone
All the
4 different
over-the-top
ways, like
things
Apple
on
Care
TV.
and AT&T Care and all these sorts of things, right? And so I think that happens too when we negotiate our business contracts, that maybe you've been dealing with the same reseller for a long time and you weren't even paying attention to your automatic price escalation clauses in your contracts because it's just the rut you're in, right? But pick up the phone and call it. Maybe you'll find that you're paying a great price. Maybe you'll find that you can cut your costs rather dramatically. And this is just the cost of doing business. We got to get in there and negotiate those fees. This is across the board, every supplier you have, right? Whether it's Gmail or other things, right? I mean, we can all cut our costs that way. But it's paying attention to that. And to the extent that people are not actively looking at renegotiating those contracts, then that's kind of a them problem and not what the credit bureaus are charging for those credit reports. We're talking $15. Okay, so you can get it down to 14. Good for you.
Yeah, how much of a difference will that actually make?
Yeah, and that's on the bureau reports, not the
Right.
tri-merge, right? The tri-merge reports are much more expensive. But again, if you're paying $80 and you can get it down to 60 on a single borrower report, that's a savings of $20. So call them up, talk to them, and find out.
Thank you. So let's pivot a little bit and talk about the workings of the mortgage market and credit scores. So first, when we look at this other side of the equation, while I guess a mono report might save a consumer less than 1% of overall origination costs, what are the potential risks to lenders? If a borrower has those undisclosed liabilities that you talked about, or if the wrong report is chosen, leading to a lower credit score and higher costs?
Yeah, so that's a great question. I was just in this great panel here at MBA that talked through a lot of these issues. And so here's what Stan Middleman of Freedom Mortgage said he saw the risk was back in the day, before we had sort of integrated tri-merge reporting, they would shop scores and go with the best or best report. It wasn't really this sort of credit scores and tri-merge came about the same time in mortgage, that we would shop the best report. And in the end, what's happened is that with the rise of Freddie and Fannie being so dominant in the market, they've brought international capital into Des Moines, Iowa for us to buy houses, right? I mean, they brought it down to our main streets to buy houses. That trust is predicated on having the very best, most efficient system available. So maybe I cut my cost down from, let's say, $60 to $20 to pull your credit report for your mortgage. But I'm a really diligent mortgage lender. So I'm not going to pull one report. I'm going to pull 3 reports. So 2020, we're back up to 60. I pulled 3 reports. I do it on the sly, on the soft report, so it's not evident anywhere that I've done that. Now, I picked the best report because it's got the 750 credit score, not the 650 credit score.
Start gaming, yeah.
Right? And I'm going to game that system. Overnight, the capital markets are going to notice. So the capital markets, who are they? Not only would it be Freddie and Fannie, but it would be the Freddie and Fannie buyers of those mortgage-backed securities are going to notice that overnight, when those single credit scores went in place of the tri-merge, that the credit scores jumped 20, 30, 40 points. And how do I know this? Because S&P Global did an awesome report on this in 2023 that looked at differentials across the three credit reports. People say to me, point blank to my face, well, there's no difference in the credit reports of the three big guys because you're all nationwide reporters. But it turns out that the regional differences from when we were tiny back in the day persist today. And that some of us are better with fintechs and some of us are better with auto lenders and so on. And so that difference persists. And the credit score differential at the high end is about 20 points. As the credit scores go lower, that differential grows to about 40 points. So they're going to notice that those scores have jumped by a massive amount overnight. Now, the differential in the cost of a mortgage today, this is from a Wall Street Journal article that I read, said that if you, and this is recent, this was August of this year, if you go down in credit score by about 20 points, the cost of that loan, the average interest rate on that loan originated at the same time, is about 1/8 of a point. So credit scores jump 20 basis points overnight or 40 basis points overnight, or not basis points, credit score points overnight, and then those guys are going to go, hey, what are you not telling me? Because there's no differential in the loan quality, right? We all know that this is now a gaming of the system. So I'm going to buy that mortgage-backed security, but I'm going to charge a higher rate for it. I'm not going to buy it at the price I was going to pay. Now, the investor in Dubai or Germany is going to say, I want more. And that more is going to raise your interest costs 1/8 or possibly 2/8 of a point, a full quarter point, because I don't know what the risk is. That's not going to go free. So I saved the borrower maybe 20 points because they're going to do the formal credit report plus the 3 soft pulls. I've saved them maybe $20 on the cost of their mortgage origination. I've saved more on the loans that don't close, but I've just jacked up the cost to borrowers by a quarter point, I don't know, some amount on the interest rate. 2 months of payments, 3 months of payments, they've covered that, plus more for the entire life of that loan that they carry. That's a huge burden to place on consumers. This is not a consumer saving argument. It's a lender cost savings argument.
Yeah, and what I find particularly interesting about that is on our Market Pulse webinar just last week, we asked the question about innovation, and the majority of lenders out there that are leveraging credit scores want to leverage something that is more predictive in nature and more innovative. And so it's just the natural byproduct of that is incorporating additional information, more data. It's like there's no diminishing marginal return.
Yeah, I mean, the cost of a defaulted loan of any kind, auto loan, mortgage loan, whatever, is huge to whoever's holding that risk. So a score that's just a little bit more predictive times however many loans you do, huge savings.
Yeah, so when we think about that, then how must lenders adjust their risk models, to ensure that prioritizing those initial savings does not inadvertently lead to outcomes that could, invoke, fair lending enforcement and result in substantial financial penalties?
Yeah, so I think that's a very real question, and some might argue that, under the current administration, with less of a focus on CFPB fairness regulation happening, that we don't need to worry about that. However, the laws are still on the books. They've got a long look-back period, so I think the fair lending risk is very high, especially if you're a lender who, under a single bureau reporting system, might only contract with one bureau. Right? That what are you not seeing, and could you have saved the borrower money or gotten them more approvals by using a different bureau than you did, or searching all three? So I think that cost, that compliance cost, will cause them to think about that. Yeah, and I just don't think the cost savings are worth it, because I don't see why Freddie or Fannie, especially if they're set free, which is another priority of the administration, as private entities, would want to reduce that risk to themselves. Under that, the mortgage insurers are under no such illusion. They're on the hook for that. They want the tri-merge report. We already talked about Wall Street wanting Wall Street and Global Street wanting that information to be in there. So I think that broadly based, there's nobody holding that credit risk or prepayment risk who wants to see less information as an outcome.
Yeah, and I find it particularly interesting with respect to the timing differences. As we were even moving our own system, up into the cloud, we found that just timing things were showing demonstrated differences. So I think there's an absolute difference in data with respect to even if it's all the same, it matters how soon it's loaded to the file as well.
Yeah, there's so many parts, moving parts to the system. And I don't know how many reporters you have at Equifax, but it's every bank, it's every
Thousands,
servicer, in addition to the original lenders, right? It's thousands, got to be easy.
Yeah. So let's then pivot to the market complications and fallout rates. I've seen you write about the fallout where loan applications start but never close. Lenders often cite fallout as a major cost driver. Let's start with the system level view. How do new system costs and compliance requirements tied to unnecessary complications outweigh the short-term savings that lenders might expect?
So there's two parts to what you said. One was the fallout risk. So let's just address what the fallout risk is and what does it mean. So fallout is a lender has a borrower come to them and say, I'm thinking about buying a house. And I don't know if they found the house and contracted on it or even a refinance. I think rates might have fallen enough. And the lender says, great, give me your information. Let's pull a credit report and see, what we're talking about here. Okay, that's a cost. And I don't care if you're doing a single bureau, soft pull, or just jump into full tri-merge hard pull, right? The costs it's a cost that they've incurred. If that loan doesn't cost and they didn't charge you for it up front, that goes against their income statement, right? And that's a huge cost. So how big of a cost is it? In 2023 and 2024, so the last 2 years we have the most complete data for, every lender on a mortgage is required to report to the Home Mortgage Disclosure Act, under the Home Mortgage Disclosure Act, to the Federal Financial, I forget what it's called, FFIEC is the collector of that information, and of course the CFPB looks at it very closely. So there were about 5 million loans applied for in those 2 years each year, and about 1.9 million didn't close. 1.9 million times, I don't know, $60 or $120. We're talking about 100 million. I have the exact numbers in the paper, but between 100 million and $250 million in credit report fees that they don't get paid back for if they didn't charge for up front. Okay, so that's what they're really talking about. All right, but then you ask a separate question, which is, okay, great. Wave the magic wand. Suddenly it's a single bureau report world. When do they start to realize the cost savings? Every loan origination system, every credit reporting CRA, which would now include opening them up to competition to all three NCRAs, not just the CRAs that currently report tri-merge, but you got to open it up. Oh, and by the way, there's still two borrowers in a lot of cases. The GSEs don't want a single report. They're going to want a merged report where you deduplicate those credit cards where they're both on it and so forth. So there's still a need for cleaning up the data, standardizing the data, and all of that. You don't get away from those costs. It didn't become just, we'll cut the cost by a third or 2/3. So those savings aren't there. You're still going to have a supplier. But like I say, right, I say in the report I didn't mention that only one of the three nationwide bureaus is also a supplier of tri-merge. We start going mono-bureau report, we may now have more entrants into that in that form, and they may, because the resellers are buying it from them, they may actually cut competition. I'm not saying that will happen, but I'm not saying it's obvious that suddenly we get 50 more credit reporting agencies out there, which is kind of what they're alleging will happen. In those that are advocating for it.
Right.
Yeah.
So some of this sounds like there's some communication gaps. So when we think about from a process perspective, how does inadequate upfront communication with borrowers contribute to that fallout? And then the second part of that question that I'd like to ask you is, could a soft pull credit check and a more frank discussion help lenders set expectations and reduce those drop-offs?
Yeah, so there's a lot of great resources out there that, sometimes you start a mortgage application on your own or a credit application and they ask you to provide your information online. And you're sort of like half the way to the whole process before you're like, I just wanted to know what mortgage rates were today, right? So I think that because of the fact, and there are some really good ones here. I just want to look at my report here. So give a couple of things. There's Guild Mortgage, there's Moshe Law, there's Bank of America, there's Fannie Mae, there's a company called Miller that had a LinkedIn post. There's a lot of great mortgage cost calculators, and there's some really terrible ones out there that say a credit report costs zero. They're all supplied by the same back engine. I don't know how that happened. There's some really bad ones, but as a consumer, I would go to the Fannie Mae credit closing cost calculator to figure it out. That will outline for you how much you're going to have to pay at closing, your escrows for taxes and insurance, because they do it for by county, so it's really good on that one. But as a lender, sitting down with people with that closing cost calculator to just walk them through what the costs are really going to be so that people don't go, oh, I thought it was just going to cost me, like a couple $100 to get the loan. No, it's going to cost you thousands of dollars to get the loan between the closing costs, prepaids, escrows, and all of that sort of thing. And I think a lot of people, especially now with the cost of property and casualty insurance, rates have gone sky high. I'm not calling out insurance companies as bad guys. Their costs have gone up tremendously with weather-related costs and lumber costs and so on for that. Cars cost so much more. And then, taxes are going up because home values continue to go up. And I look at my mortgage, which I took out in 2011. My taxes and insurance are now 2/3 of my mortgage payment. They're no longer, sort of a afterthought. They are a really big burden on that. And so I think that there's, to get rid of some of that fallout requires talking to your borrowers. You may not get around the fact that you find out later that something is not appropriate for them, or that circumstances change, but it could cut your fallout costs rather dramatically. And a lot of the denials are not even tied to credit, it's tied to other things. So, a lot of them are people simply didn't follow through, didn't supply the rest of the information. Maybe you could have figured out they were just window shopping before you spent the money.
Yeah, so thinking about that, and I know we've talked about doing calculations of fallout rates specifically as it compares from refi to new home purchase. When we think about that, exploring what type of insights could that data reveal, especially as we consider the differences in how refi fallout rates may compare to purchase fallout rates, especially if we move into a more favorable interest rate environment.
Yeah, so we are coming potentially to that. There's a lot of moving parts in our economy right now, and I know we've talked about that in Market Pulse webinars every month about which parts are moving this month to affect that. But so the fallout rates are significantly lower in refinance simply because you're talking to an experienced mortgage borrower.
Yeah, they've been there.
Right? A lot of home purchase loans are first-time home buyers. Not all, obviously not all, but many times it's a first-time buyer going through that process, so you see higher fallouts. Refinance borrowers, a lower fallout rate. They know what they're in for. It's really just what the rate is and whether they can save enough money. So, looking at it from that standpoint, I think that, it's a great time to be reaching out to your current portfolios and saying, again, whether you're a broker who sells the loan or a lender who portfolios the loan or somebody who sells it into capital markets, being able to say, hey, Emmaline, I saw you got a mortgage with us a couple of years ago. Just wanted to say now might be a good time for you to think about refinancing. And I wouldn't talk to all the borrowers that way, but there's some of us who have loans that we took out in the last couple of years.
You can use analytics to get to that.
Yeah, exactly. And that analytics is known. There's a lot of great companies here that provide those analytics on the portfolios. So I think that's a great way to reach out to borrowers and say, hey, now's the time to do this. And, some people didn't know. I didn't even know this until I started digging for this report. Little known secret, that annual credit report can be weekly. You don't have to wait a whole year to find out what your credit report's doing. And then, of course, there's Credit Karma and other places where you can get those scores. And credit cards now provide you the scores. You pretty much have a good idea of what you're doing. Yeah, it's very accessible and very pro-consumer.
Yeah. So we've focused, and one of the reasons I really enjoy talking to you is how you can go from micro to macro. So I want to pull it up a little bit and get
Sure.
into a broader, some broader implication and future outlook. So as we zoom out, beyond the immediate costs, what are the broader economic impacts of credit report accuracy and competition on the housing market and consumer access to credit?
I've been in this industry, truthfully, since about 1994 when I did my first report for HUD. Okay, I've been doing this a long, long time, so I've seen a lot of changes. And I see all of the great innovations that are happening in the marketplace as we think about things like cash flow data, right? Bank account data being brought in, rental payments potentially being brought in, and the challenges, the benefits of that. Instant verification of employment and income, where it used to take weeks to do that. And the fraud that goes along with, printmycreditreport.com or print my employment report, my paystub.com, right? And how back in the day we used to manually underwrite loans with 3 bureau reports, no credit scores, and how we would cherry pick or miss things there that could potentially be a problem. When I talk about bringing in global capital markets to our credit, there's only one other country, Denmark, that has a long-term fixed-rate prepayable mortgage. Nobody else has adopted that. You go to Canada, it's a 5-year mortgage. Canada's pretty advanced, not as advanced in this as we are. So how much are you paying? You're paying about 300 basis points, so about 3% more than the federal government pays to borrow on a 10-year treasury. And that's bringing people who will never meet you, never know your name, never know where you live. And they're saying, hey, sure, I'll give her some money so she can buy a house, right? This is magic in my world. So between all the innovation that's happening, the better modeling, analytics and all that behind it, the quality of the credit reports that we now have that continues to get better every day, you're making investments every day on how you can bring in more reporters, the quality control analytics of, hey, how many of my consumers are reporting into us that the data is inaccurate? Hey, servicer, get your act together, right? The enforcement that has to go along with that. There's just so much good that's happened, and it's so efficient and so cheap. I know it sounds expensive to get a mortgage rate at 6% or 7%. Well, it's not 6% yet, 7% in today's marketplace. But to think about how much more expensive it would be, or how much more that risk you, the consumer, would bear on interest rate and so on. This is just, to me, marvelous.
It is, yeah. So I agree with you on that, but I'm interested now in the regulatory perspective in particular. And so when we think about regulatory trends or potential policy changes, because things, they go in ebbs and flows, right? And when we think about the influencing dynamics of credit reporting and mortgage pricing in the next few years, where do you see things going, or how do you think those things will influence?
Let me just address the elephant in the room, which is will Freddie Mac and Fannie Mae be privatized and sort of set free again? They've been in conservatorship since 2008. It's a long time, right? 17 years. So if they are put back in the private sector, I think that we will see, again, more drive for competition, but that competition will be not less information, but more information, right? And similarly, I see that the regulatory burdens will ebb and flow. Each administration, this is not a comment on the current administration, but every administration changes their focus, right? But the laws that Congress has put in place still remain. And that ultimately, less enforcement, more enforcement. When more enforcement happens, it's very expensive. So keeping an eye to that, I think, is still really critically important. Compliance costs are another way to actually look at being more competitive. And I'll do this as a way of saying, when companies engage in a fair lending analysis of their AUS system or their other origination system, or how they market loans and so forth, they often find that in trying to be more fair, they actually open the door wider because they're like, oh, I didn't know that was a barrier of what I was looking at, right? And somebody made a comment earlier today that, hey, the GSEs are not even using credit scores in underwriting. What are they using? They're directly using that tri-merge report and finding what matters and what doesn't matter directly in what they're underwriting, right? Trying to open that door wider. Credit scores are used in pricing. Well, to get more accurate pricing, you need more accurate scores, right? And we're seeing that competition really opening up now with VantageScore and the FICO Score 10T. That's going to open a door to more competition. And, it's something we haven't had before, both scores being used as an option. So more competition is part of that regulatory change that I see. And who knows where it'll be 20 years from now or 5 years from now. Could change very dramatically.
Yeah, you talked about the accessibility of reports and scores in general. And so when we think about the general consumer education, there's a lot that we've talked about today that many are even learning that are part of the industry and have been in the industry for a long time. So if we think about the broader education of the general person, the general consumer, individuals, how can empowering borrowers at that broader scale to understand their reports and options and scores, help them to reduce costs and to make better decisions?
So I know that you've got college kids, not at home anymore, but you've got college kids, right? And what I find really heartening is that, starting with my gen, I'm a Gen Xer, I think you probably are too, that, credit reports sort of became something we became aware of when we got a mortgage. Maybe not even then. I'm not really sure, right? That took a while. But today, college kids are talking to each other about how they can build their credit report and how they can get access to credit and which credit card gets the best value. And that's something that I didn't even think about, getting a credit card in college. That wasn't even a possibility. We didn't even have interstate branch banking back then, right? So the innovations matter. And then companies that have come about that counsel you on your credit scores for free. And I mentioned Credit Karma earlier, but there are others. The fact that your credit card companies now say, hey, we pulled your credit report. Do you want to, not your report, your score. Do you want to know your score? And then there was pushback. Oh, that's the VantageScore. Nobody's using that for real. Oh, yes, they are. Right? That's a big part of auto lending, card lending, and soon to be mortgage lending. So those are legit scores. Right?
They've been around for a long time.
And they've been around a long time, and they've proven themselves to be very accurate. So I see now that younger adults, and I don't want to label them because I think these labels sometimes get crazy, but talking to 20, 25-year-olds, they know their credit score, they know their bank balance, right? The ability to test your balance every day. We used to wait for the mail to come with that balance, or worse, the notice of overdraft, right? Now down to just every day, you can pull it up and see what's coming through your account. So I see younger people as being more and more empowered about that. It's really reaching out and making sure that everybody is aware of that same information. Social media is a great way that that's happening, and I see some of the Equifax stuff happening on social media. I think it's great content and very helpful. So.
Well, thank you. And so I guess you mentioned several emerging technologies or technologies that have just evolved over time, like the accessibility through applications on your phone, or just the sharing of information in a more broad sense. What other types of innovations or technologies do you see improving efficiency that could help with cost effectiveness in credit reporting?
So ultimately, efficiency comes down to cost, and cost is not a single item. It's got to be the full picture, right? Speed is a big one. If I can cut closing costs down because the appraisals are better faster, that the loan origination systems are pulling the information in directly rather than manual data entry, right, back in the day, kinds of things. And again, I talk about instant verification of credit, identity, the employment reports, right? That's a big key now, getting that instant employment. And if it's not instant because it's not on the work number, that it becomes then that you'll provide that service, call them up and get it done very, very quickly. So other innovations, I hate the term AI, but writ large is that our computer systems are getting bigger, better, faster. I talked about trended data. The reason trended data wasn't used in originations for so long was that the pipes needed to transfer that over the internet weren't big enough for these gigantic files in a timely way, right? I don't want it overnight, I want it now. I'm pulling the credit report now, I want it now. So the fact that cloud report, and when did cloud stuff innovate? Steve Jobs was talking about it, right? We were going to move to the cloud, and everybody said, what's the cloud? Like, come on, Steve, what are you talking about? It's now, everything's on the cloud. Yeah. So what does that give me? It gives me timeliness, it gives me backup systems. So if this one's down, I've got that one that can work. As if you build the system right, you've got backups, right? That turns out South Korea didn't do that, and there's government data statistics are down, like gone because there was a fire. So backups, got to have backups. Okay, but that efficiency is not just about cost directly, it's about timeliness, and it's about speed, right? And so these innovations are happening faster than you and I are even talking about it. So
yeah,
that's where I see
it is
those
really, and especially like
innovations.
one of the things that was particularly interesting to me today was the migration. We talk about AI, artificial intelligence, and then the movement to quantum computing, which
Yes.
is really just the probabilistic thinking, like the human brain, how we can think through scenarios. That's all quantum computing is. So I'm particularly interested and looking forward to some of those innovations, especially as we look to expand things that are happening here. So I do have one final question for
Sure.
you, and this is coming from a more global perspective. We've talked about you hit on some of the global things already with how other countries may be doing things similar or different than us. But when we think about global practices and how they compare, are there lessons in addition to the ones you've already shared from other countries and their lending systems that the U.S. Could learn from? Because we oftentimes think we know a lot, but there's a lot of stuff that we can learn from elsewhere that, from a cross-pollination perspective, to continue to improve as well.
Yeah, I mean, for better or for worse, GDPR, which was it's a consumer data portability and privacy, right? So I think of those as being innovations that were very pro-consumer that we in the U.S. were very reluctant to do. Again, with getting out of that rut has now created opportunity, right? So every time we have these changes, we tend to think, oh, they're just making me change the way I'm doing for no good. And now I see it as companies that went through those changes are now like, oh, wow, here was an opportunity I didn't think about. And so I think of these things as there's still a lot of opportunity to change our thinking and about the way that we do things. I'm pretty sure when the Work Number started, people were like, why do we need that? And now
Right.
that I look at it again from a consumer perspective, I'm like, that was the biggest benefit to me. Right,
It's like the question
to have
now
my
is
payroll
like,
data.
why did we do that sooner?
Right,
Yeah.
exactly.
Mhm.
And so I'd love to see that more of those innovations happen. The data collection is out there. It's starting to be better. Rent's another good example. So where will we be? The big thinking. Other countries didn't have as much reliance on credit, so they had to use rental payments. How did they get that? They got that through bank statements. They got that through reporting companies and so on. So I look at other countries as the way they push these different consumer protections, banking protections as opportunities that we could look at for how can we save money, say yes to more borrowers in a way that they're successful. I don't want to see somebody get a mortgage loan and fail. So I really think of that as being both beneficial.
Yeah, well, I encourage everyone out there. This was one of the most robust papers I've read in a long time that takes it from the shop to the top. I think it has something relevant for anyone in the industry. I certainly thoroughly enjoyed it as much as I enjoyed the conversation, which was based on your paper that you wrote. So first, I want to thank you for sharing your insights and walking us through this important research. Your study, I feel like it grounds the debate in data context, practical implications. How can our listeners get in touch with you if they have questions?
Sure. Love to hear that. Well, two ways. One is directly through Amy at accuts.com. That's the easy way. And then the alternative way is through your Equifax team, because I'm a regular, contributor to your webinars.
To our whole Market Pulse series and our podcast
Yep.
series. Yep.
Yep. So it's another great way to reach me.
Really appreciate your time and your expertise. As always, I always enjoy having a conversation with you, and we'll be watching closely as this continues to evolve. And thank you to everyone tuning in to the special edition of the Market Pulse podcast, recorded live at MBA Annual 25. Stay connected for more insights on what's next in credit, housing, and financial inclusion.
The information and opinions provided in this podcast are intended as general guidance only and are subject to change without notice. The views presented during the podcast are those of the presenter as of the date this podcast was recorded and do not necessarily reflect official positions of Equifax. Investor analysts should direct inquiries using the Contact Us box on the Investor Relations section at Equifax.com.